Welcome to this explainer. I am absolutely thrilled to have you here today because we are going to unpack something truly fascinating. Look, if you've been watching the markets lately, you've probably noticed that gold, silver, equities, and interest rates are all moving, right? And in some cases, they're going through some pretty aggressive corrections. But instead of getting caught up in the daily panic of red and green arrows, we're going to adopt an expert macro lens today to look at the massive, hidden forces moving beneath the surface. I want you to think of today's markets like an ocean. The daily price action, that's just the waves. But we are going to look at the structural currents and really the massive macro iceberg that's dictating where the entire ship is actually headed. Okay, let's dive into this with a number that should honestly make everyone sit up and take notice. 20%. Right now, nearly 20% of all United States federal revenue is being consumed simply to pay the interest on the national debt. We're actually on the verge of breaking the historical record of 19% that was set way back in 1991. Just think about that for a second. 1/5 of all taxes collected isn't going to infrastructure or defense or innovation. No, it's just treading water, paying the interest on past borrowing. This right here, this is the absolute foundation of everything we're going to discuss today. To understand exactly what this means, we've structured our explainer into 5 key areas. First, we have the elephant, U.S. debt. Second, the monetary cycle and debasement. Third, rates and bond vigilantes. Fourth, gold and equities dynamics. And finally, Bitcoin beyond ideology. Let's get right into it. Section 1, the elephant, U.S. debt. So let's start with the absolute foundation of our current market reality. You simply cannot analyze asset prices today without addressing the staggering scale of the United States public debt. It is literally the center of gravity for the global financial system. The U.S. public debt is now hovering near the $40 trillion mark. And look, that isn't just a big number, it is a structural weight on the entire global economy. Because the U.S. issues the world's primary reserve currency, when it gets caught in a vicious cycle of issuing debt just to pay off old debt, it creates this unique microclimate for all global assets. So trying to evaluate the stock market or commodities without factoring in this $40 trillion reality, well, it's literally like ignoring the iceberg right in front of your ship. And this brilliantly illustrates what we're up against. The current data highlights a major mathematical anomaly. We've got a federal deficit running at about 6% of GDP, which is completely failing to return to a normalized 3% target. But at the exact same time, unemployment is sitting at a historically low 4%. Statistically speaking, running a massive 6% deficit while the economy is essentially fully employed is incredibly unusual. Historically, you only ever see this kind of massive government spending and divergence during times of global world wars. Yet here we are, doing it right in the middle of peacetime. Section 2, the monetary cycle and debasement. So you might be wondering, what is the direct, unavoidable consequence of running wartime deficits during peacetime? Well, we are talking about currency debasement. Debasement is the silent, structural loss of a fiat currency's purchasing power. When a country has elevated debt and runs massive deficits like we just saw, one of the easiest ways out is simply to inflate the debt away. High real interest rates combined with this sort of fiscal dominance, it acts as a silent tax. It actively alters the underlying value of your savings and your assets over time. You might look at your stock portfolio and see the numbers going up, feeling pretty good about it, but if the currency those stocks are priced in is losing its value, your actual purchasing power might be standing completely still or even shrinking. And this leads us to a crucial thesis. Most traditional investment strategies out there are entirely focused on the economic cycle. They're always trying to guess if we are in reflation, stagflation, or heading for a recession. But history tells us there are periods where the economic cycle takes a back seat to the monetary cycle. When a government is engaged in systemic debasement to manage its debt, well, portfolios absolutely must adapt. If you're only hedged against a mild economic recession, but you're completely exposed to monetary debasement, your real wealth is totally at risk. Section 3, rates and bond vigilantes. Now, let's take a look at how the folks actually holding this $40 trillion in debt, the bond market, are reacting to these deficits, because they definitely aren't just sitting by idly. If we look closely at liquidity, we see completely contradictory signals. On the surface, the M2 money supply is rising, which usually supports a global risk-on environment for stocks. But if you look under the hood, using X-ray vision on the crucial wholesale plumbing of the U.S. financial system, it tells a completely different story. The reverse repo account, which is basically where institutions park their excess cash, is practically drained, and money parked at the Treasury is totally stalling. We're seeing a market that appears liquid, sure, but it's actually relying on highly complex intermarket transfers of capital. Let's see how this builds into the currency markets. Ever since 2008, the US dollar has respected a massive long-term support trendline. Today, the DXY US dollar index is compressing right near the critical 100-point psychological level. The bond market is essentially stepping up and demanding a premium. These bond vigilantes are keeping nominal rates high, pushing real rates into positive territory, specifically to put pressure on policymakers. They are demanding fiscal discipline because, as we saw, the government completely missed its 3% deficit target. So the entire market is basically sitting on its hands right now, watching these high rates and waiting for signals from the Federal Reserve to see if they're going to act as a hawk to fix the deficit or a dove to save the economy.
Section 4. Gold and Equities Dynamics.
All right, with these massive macro currents established, the historic debt, the silent debasement, and tight liquidity, let's apply this directly to the assets in your portfolio. We'll start with equities and gold. When measuring the risk of a major stock market crash, experts don't just stare at price charts. No, they look at the ratio between copper and oil. Now, what's really interesting about this is that copper is the ultimate symbol of economic reflation and growth. Oil, on the other hand, when prices stay high while growth slows down, is the classic symbol of stagflation. As long as copper holds relative strength against oil, it tells us the market still believes in reflation. And in a reflationary environment, broader market corrections are usually capped around a very manageable 10%. It's a vital metric to keep an eye on. And speaking of corrections, let's talk about gold for a second. Gold recently dropped about 20%, falling all the way back to its 50-week moving average. For a lot of retail investors who bought at the absolute top, this feels like a total panic. But looking through our expert macro lens, this isn't a failure of the asset at all. Gold just had a massive debasement-fueled rally. This pullback is honestly a textbook example of institutional rebalancing. Smart investors acknowledge that extreme growths, they execute a disciplined take profit, and then they use that new liquidity to buy other structurally sound assets that might just be temporarily underperforming. Rebalancing is exactly how you survive the monetary cycle.
Section 5. Bitcoin Beyond Ideology.
Finally, let's move on to perhaps the most debated asset of our time, Bitcoin. And we're going to examine it strictly through the established macro framework we've just built together, leaving all that religious investment fervor and internet hype completely at the door. Just look at how the institutional narrative has matured here. We just saw a major drop in Bitcoin's price, right? Over 50% from its highs. But notice what we didn't see. We didn't see the traditional media running headlines screaming, "Bitcoin is dead" or "Bitcoin is a scam" like they used to do every single time. Instead, top financial figures, guys like Jerome Powell and Kevin Warsh, are openly referring to it as digital gold or gold for those under 40. The asset has, for all intents and purposes, graduated into the mainstream financial conversation. So, when an asset like this drops 50%, you really have to stop and ask a critical, objective question. Has the underlying protocol failed? Did the fundamentals change? Was the code hacked? And the answer to all of that is no. Statistically, Bitcoin is simply experiencing a predictable bear market that historically occurs right on schedule during the second year of the US presidential cycle. It isn't a fundamental failure of the technology, it's simply a victim of the current macroeconomic context. So the absolutely crucial point here is understanding exactly what that context is. Right now, Bitcoin faces massive macro headwinds. We have high positive real interest rates sitting over 2%, which makes risk-free yields highly, highly attractive. Furthermore, we are seeing a massive rotation of wholesale liquidity. Big money is taking profits and moving their capital into highly anticipated AI and tech IPOs like SpaceX and Anthropic. Add in a general risk-off environment due to global geopolitical tension, and it's perfectly logical why liquidity is temporarily draining from digital assets. It's an issue of macro plumbing, not a flaw in the technology itself. Which brings us to our final thought for this explainer. We've looked at the $40 trillion debt, the draining liquidity, those bond vigilantes, and exactly how hard assets like gold and Bitcoin react to these massive forces. So I want to leave you with this provocative question to ask yourself today. Is your portfolio built merely to survive a standard economic recession, or is it truly protected against the massive, silent reality of monetary debasement? Thank you so much for exploring this macro iceberg with me today. Keep your eyes on those structural currents, stay disciplined, and keep learning. Catch you next time.